Hello, my friends. Today is February 10th, and this is Markets Weekly. So, this week was super exciting in markets, so we have a lot to talk about. First, we have to talk about the equity market. S&P 500 was making records throughout the week, finally crossed 5,000 and closed above it for the first time ever. Again, this should not surprise any of you. We've been talking about the potential for a crash up for the past 2 months. However, I am very cautious on the equity market right now. So let's talk about what might be driving this surge and why I am cautious. Okay, secondly, let's talk a little bit about the labor market. So, on the one hand, the non-farm payrolls report is showing that we have strong job gains. On the other hand, we're seeing all these big layoff notices in the news every single day. And we also seem to have a rise in multiple job holders. Let's talk about the dynamics in the labor market and why it might not be as concerning as it might appear to be. And lastly, let's talk a little bit about the prospect of a Fed rate cut in March. So we've been talking about this for some time, but it looks like more and more that the Fed is really going to be united in pushing against a March rate cut. Let's look at how the market has been pricing this over the past few weeks and why, at the moment, it's still not fully given up yet. Okay, starting with the S&P 500. So, as we've been talking about, I look at this year as a year that should be pretty bullish for the equity market. But again, if I see something that goes up every single day, that's, I think, a cause for concern because oftentimes when you see something go up every single day, it tends to reverse sharply. So at the moment, it seems like the market is, for me, I approach it cautiously. But in order to better understand what might be driving the market higher and higher, let's listen to some stories that people tell in explaining this price action. After all, at the end of the day, markets is just buying and selling, and people buy and sell for many different reasons. So these stories could be helpful. The most obvious story, of course, is that the Fed is about to cut rates, which indeed it is. Maybe not March, but the Fed is pretty clear that they're going to be embarking on a rate cut cycle this year. When that happens, maybe the market doesn't really care, but usually when they hear rate cuts, asset prices go up. Now, we've already seen this though for the past two months, so that to me is not a persuasive story. In fact, more recently, the market has been pricing in fewer cuts this year. Another story is that asset managers, the active asset managers that have to manage to a benchmark like the S&P 500, are piling in because they are afraid of missing out. And this makes a lot of sense to me. If you are an asset manager sitting out this rally, watching the S&P 500 go to the moon, well, that means that you are underperforming. And if you are underperforming, maybe your clients are unhappy and they fire you. If you look at surveys on active manager equity exposure, you can see that it ticked down a little bit in December, but now it's ticking back up again. So that does seem to be part of the reason pushing stocks higher. Now, what I find most persuasive, of course, is looking at the underlying options activity. So at a high level, when you look at the S&P 500 and break out the performance by its components, you notice that a lot of the gains have come from communication services or tech, basically the Mag 7, like Facebook, like Google, and of course, NVIDIA. Now, when I look at NVIDIA and looking at its option implied volatility, what I see is that there's a lot of people who seem to be YOLOing in this stock. For example, the way that I look at this is looking at the options implied volatility surface. Now, normally you would expect volatility to be more expensive and skewed towards the left. So, structurally speaking, if you're an asset manager, in order to prudently manage your exposure, you would buy some insurance, you would buy puts. And because of this structural demand for puts, you would expect implied volatility to be higher to the left of the strike. But for NVIDIA, you can see it's not the case at all. It's very much skewed to the right. And that tells me that there's a lot of people buying calls, probably trying to YOLO this. And as we know, when you YOLO something, your long call Oftentimes, market makers short the call, and so they hedge by buying the underlying, and you can make the asset prices go up a lot. We've seen this happen over and over again over the past few years. And so it seems to me that there's a lot of people who are YOLOing these Mag 7 stocks and pushing the indexes higher. And these can, I have no idea how high it can go, but usually it seems like this eventually reverses and sometimes violently. When I look at the vol surface on an index level, the vol skew, it looks like, looking at fixed strike vol, it looks like Friday compared to the past, that it looks like more and more of the market participants are selling calls on S&P 500 futures and buying puts. Now, that tells me that it's likely that going forward, the upside is more limited and more people are afraid of a sharp reversal. Again, I have no idea how high the S&P 500 is going to go, and I'm very positive on it going forward, but I think this is getting a little bit ridiculous, so I'm very cautious here. Again, I don't have a crystal ball. Okay, so let's talk a little bit about the labor market. So when I turn on the news every day, I'm seeing these big mass layoff reports, a lot of them from tech companies and even recently from UPS. But at the same time, the official job reports is saying that job market is booming. A lot of jobs are created. So what's going on here? I think an important way to reconcile this is to understand that if you are the US or any big country, any company actually, every day there are jobs created and every day there are people laid off. So again, there's job cuts and job growth. And at the end of the day, though, what we want to see is, are there more jobs created than jobs destroyed? So we've been seeing a lot of very visible layoffs, and it seems like the tendency for companies is, as they go on, gradually hire a few people every day or every month and so forth. But if they get into a situation where they suddenly don't need a lot of people, maybe economic circumstances change, then they tend to lay people off a lot. So you don't often see people hiring, let's say, 20,000 people at a time, but from time to time you can see people get laid off, 20,000 people at a time. So there is this asymmetry here to keep in mind. Now, the jobs report that we get every month basically looks at everything, looks at hires and fires, and at the end of the day, taking that stuff into account, it tries to figure out the amount of net jobs created every month. So even though we're seeing a lot of people being fired in the news, there's still a lot of people under the surface that are being hired. And again, these don't happen in mass, so they don't get as much attention. And so all in all, this is important to keep in mind. When we're looking at job layoffs, we're only looking at the firings. We're not hearing about the hirings, and so that skews our perception as to what's happening in the labor market. Now, when you dig a little bit deeper into what's happening with these layoffs, one thing that I notice is that they seem to be focused in the tech sector, and I don't think that's surprising. Now, over the past few years, we've seen tech absolutely boom, and of course, we also know that the economy is slowing. It was running far above trend, now it's slowing towards trend. So it would make sense to me to think that, some of these companies, maybe they overhired and maybe they don't need as many people. Another point is that it seems like AI might be playing a role in automation. So, for example, looking at the UPS announcement, you would think that they're laying off a whole bunch of UPS drivers, but that's actually not the case. What the management there is saying is that they're laying off a lot of middle management because they think that they can replace those guys with AI. I suspect, looking at the tech layoffs, a lot of automation is happening in tech companies as well. Obviously, these guys are good at AI, and of course, a lot of what AI does is what your standard white-collar person would do, be it code or be it to, say, create some kind of image or synthesis. So it would make sense that maybe the tech companies are using AI to replace some of their own workers. Now, eventually, this will probably get down to blue-collar workers as well. You can imagine one day we'll have self-driving delivery trucks and so forth, but at the moment, it seems concentrated in white-collar. And these tech people and these white-collar workers, I think, tend to be overrepresented in social media and in the news. And so we tend to hear about this a lot more, and that colors our perception. Now, the last thing I want to talk about with regards to the labor market is that I hear many people talking about the surge in multiple job holders. And when you look at a graph of multiple job holders, you'll notice that it has been rising. But to make this a bit more even in comparing, we should look at multiple job holders as a percentage of the employed, and we should zoom out a little bit. When you do that, you can see that the rise in multiple job holders as a percentage of the employed really isn't remarkable at all. It's very much in line with what we've seen over the past few years. Another point related to this is that when people look at multiple job holders, they often just assume the worst. They assume that people are really desperate, and so they're getting multiple jobs in order to get by. And that's definitely the case for some people. But there are also other possibilities as well. You could also have multiple jobs if you are ambitious. Now, a big structural change since 2020 is that there is a lot more opportunity to work remotely. So you can have a lot of people who, because not necessarily out of hardship, but because they just want to make more money, maybe to buy a bigger car or something like that, to go and work multiple jobs. In fact, there is a forum on Reddit called Overemployed that's dedicated to teaching people how to have multiple online jobs and make a lot of money, sometimes without telling your employer. So this is a structural change in how employment works. And so I would actually expect, structurally speaking, for there to be more multiple job holders as a percentage of the employed. So there's a different way to interpret this, and I would not immediately reach for the doomer interpretation. So the last thing that I want to talk about is the prospect of a Fed cut in March. Now, a couple months ago, I was thinking that we would most likely have a Fed cut, and the market was pricing that as well. So if you look at a time history of the market's pricing of a March cut, you'll see that initially it was very unlikely, and then a few weeks ago it was basically certain, and now it's sitting at about 20%. So what's the driver for that? The driver for that is that the Fed seems to be coordinating a campaign to dissuade the market in pricing in any March cut. Now that began with Chair Powell basically categorically, well, not categorically, but very strongly pushing against that in the most recent FOMC meeting. Last week, Chair Powell also did an interview with 60 Minutes and basically said the same thing. Let's listen to what he said.
We wondered about an interest rate cut in the next committee meeting in March.
I think it's not likely that this committee will reach that level of confidence in time for the March meeting, which is in 7 weeks.
The next committee vote, then, would be in May.
We just want to see more good data along those lines. It doesn't need to be better than what we've seen or even as good. It just needs to be good. And so we do expect to see that.
So again, Chair Powell is telling you that he thinks things are good. He just wants to see more good data to be sure. And so he's trying to discourage the market from pricing in a rate cut in March. And I think he seems to be sending out all the other Fed presidents to come and say the same thing. But notwithstanding that, though, you still see the market pricing in about a 20% chance of a cut. And I think that's because the data plus what the Fed has communicated about how they look at the world is strongly suggesting that a cut, it may be appropriate. On Friday, we got the revised CPI data, which usually no one cares about, but because Governor Waller once upon a time said, I'm going to be looking carefully at the revised CPI to make sure the data is good, so now everyone has to care about it. And the revised CPI showed slightly lower headline inflation and unchanged core, which basically affirms that the disinflation we've been seeing is indeed true. But notwithstanding that, though, unless we get some serious change in the data this month, I think that the Fed really doesn't want to cut in March. That being said, the market continues to suspect that the Fed is going to embark upon a relatively quick cutting cycle with 5 cuts priced in throughout this year. Let's see how that happens. Let's see if that actually happens, depending on how the data unfolds. Okay, so that's all I prepared for today. Thanks so much for tuning in. If you're interested in my thoughts, check out my blog at feddie.com. And if you're interested in learning more about markets, check out my courses at centralbanking101.com. Talk to you all next week.